Do you know the different types of permanent life insurance and which one is best for you? There's a world of options out there, each with their own unique benefits and considerations. At the heart of it all is the concept of permanent life insurance, an umbrella term for insurance policies that provide lifelong coverage, unlike term life insurance that offers protection for a specific period. The beauty of permanent life insurance lies in its dual nature. Not only does it promise a death benefit, but it also has a cash value component that can grow over time. Now, under this umbrella, we find four distinct types: whole life insurance, universal life insurance, indexed universal life insurance, and variable universal life insurance. Each of these comes with its own set of features, costs, and benefits, and understanding these can help you make an informed decision. Stay tuned as we dive deep into the world of permanent life insurance. First on the list is whole life insurance. Whole life insurance, as the name suggests, is designed to provide coverage for your entire lifetime. Unlike term life insurance, which covers you for a specified term, whole life insurance doesn't expire as long as you're paying the premiums. One of the key features of whole life insurance is the fixed premium. This means the amount you pay for your policy each month remains constant regardless of your age or health status. This can be especially beneficial for budgeting purposes, as you'll know exactly what your expense will be month after month, year after year. Another advantage of whole life insurance is the guaranteed death benefit. This ensures that your beneficiaries will receive a predetermined amount of money upon your death. No matter when that unfortunate event occurs, your loved ones will have financial support, providing peace of mind for you and them. But there's more to whole life insurance than just a death benefit. One of its unique aspects is the cash value component. This is a savings account of sorts that grows over time, tax deferred. You can even borrow against this cash value, giving you financial flexibility during your lifetime. Now let's talk about the cost. Generally, whole life insurance premiums are higher than term life insurance. This is because of the lifetime coverage and cash value component. Typically, the younger you are when you purchase a policy, the lower your premium will be. Therefore, it's often advantageous to lock in a rate when you're young and healthy. However, it's important to note that whole life insurance might not be the best fit for everyone. It's more expensive, and not everyone will need life insurance coverage for their entire lifetime. Therefore, it's crucial to consider your personal circumstances, financial goals, and future needs. That was a brief run-through of whole life insurance. Moving on to our next type. Next, we have universal life insurance. This type of insurance is a blend of life coverage and investment savings, making it a unique and flexible option. The fascinating feature of universal life insurance is its adaptability. You can modify the premium and death benefits according to your financial situation. The policy has two main components: the insurance part, which provides death benefits, and the savings part, which builds cash value over time. The cash value is invested, and the returns are credited back into the policy, which can be a fantastic way to grow your wealth, tax deferred. One of the key highlights of universal life insurance is the flexible premium. This feature allows you to adjust the amount you pay within certain limits based on your current financial circumstances. If you're in a tight spot, you can pay less, and when you're doing well, you can pay more to build up your cash value faster. The adjustable death benefit is another attractive feature. You have the option to decrease or increase your death benefit to suit your changing needs. This could be beneficial if, for instance, you've just had a child and want to ensure they're financially secure should anything happen to you. Now let's talk about cost. The price of a universal life insurance policy can vary widely based on factors such as your age, health status, and the amount of coverage you want. Generally speaking, the younger you are when you buy the policy, the less expensive it will be. For example, a healthy individual in their 30s might pay less for a policy than someone in their 60s. However, keep in mind, with greater flexibility comes increased responsibility. It's crucial to manage the policy properly to ensure it remains in force and continues to meet your needs. That sums up universal life insurance. Up next, indexed universal life insurance. Now let's talk about indexed universal life insurance. Indexed universal life insurance, often referred to as IUL, is a type of permanent life insurance that adds a unique twist to the mix. It not only provides a death benefit, but also offers the potential for cash value growth based on the performance of an external market index, all without the risk of investing directly in the market. This insurance type is like universal life insurance, but instead of earning a fixed interest rate, the cash value of your policy can grow based on a stock market index like the S&P 500. However, it's important to note that you're not actually investing in the stock market. Your policy is merely indexed to it. That means if the market does well, your cash value has the potential to grow. But if the market declines, your cash value is protected from direct loss. One of the major benefits of IUL is this downside protection feature. Even if the index performs poorly, the cash value of your policy won't drop below zero. Some policies even offer a guaranteed minimum interest rate, providing an added layer of security. Another unique benefit of IUL is its flexibility. You can adjust the premium amounts and death benefits to suit your circumstances, making it a popular choice for those seeking adaptability in their insurance plans. Now, when it comes to cost, IUL policies can be a bit more expensive than basic universal life insurance. This is primarily due to the added potential for cash value growth and the downside protection feature. Typically, younger individuals may find these policies more affordable as premiums tend to increase with age. On average, people in their 30s and 40s might find this a cost-effective solution for long-term financial planning. In conclusion, indexed universal life insurance provides a death benefit, potential for cash value growth, downside protection, and flexibility. It's a compelling choice for those looking for an adaptable policy with the potential for higher returns. That was all about indexed universal life insurance. Now on to our final type. Last but not least, variable universal life insurance. Let's take a journey into the world of variable universal life, or VUL insurance. This type of permanent life insurance has a unique feature that sets it apart from the rest. Investment options. Yes, you heard it right. With VUL insurance, your premium payments are not just set aside for death benefits, but a portion also goes into a separate account that can be invested in a variety of sub-accounts. These sub-accounts function much like mutual funds and can include stocks, bonds, or money market instruments, providing potential for high cash value growth. Now you might be thinking, that sounds exciting. And yes, it can be. The potential for growth is one of the key benefits of VUL insurance. However, it's important to remember that with great reward comes great risk. The value of your investments can fluctuate, and if the market doesn't perform well, your cash value and death benefit may decrease. But don't worry, most policies have a guaranteed minimum death benefit, so your loved ones will still receive some payout. Another benefit of VUL insurance is flexibility. Unlike other types of life insurance where premiums are fixed, with VUL, you have the option to adjust your premiums and death benefit as your needs change. This can be a great advantage, particularly if your financial situation is likely to fluctuate over time. Now let's talk about cost. As you might expect, the potential for high returns and flexibility of this insurance type does come at a price. VUL insurance is typically more expensive than other types of permanent life insurance. The exact cost will depend on many factors, but as a general rule of thumb, the younger you are when you take out the policy, the lower your premiums will be. So there you have it. Variable universal life insurance, a flexible option with investment potential, but also a degree of risk. Remember, it's crucial to consider your financial situation, your risk tolerance, and your long-term goals before deciding if this is the right type of insurance for you. That concludes our discussion on variable universal life insurance. Now that we've covered all 4 types of permanent life insurance, you might be wondering which one is best for you. And that's a great question. Let's take a moment to revisit what we've learned and highlight the key points that might guide your decision. Whole life insurance, as we've discussed, offers a guaranteed death benefit, a fixed premium, and a cash value component that grows over time. This might be a good fit if you value stability and predictability, and you have the budget to accommodate higher premiums. Next, we talked about universal life insurance. This type is known for its flexibility, allowing you to adjust your premium payments and death benefit as your needs change. If you're someone who appreciates adaptability and wants to align your coverage with your evolving circumstances, universal life could be the right choice. The third type we discussed was indexed universal life insurance. This offers the same flexibility as universal life, but with an added potential for cash value growth linked to a market index. If you're comfortable with a degree of market risk for the chance of higher returns, this might be the policy for you. Finally, we delved into variable universal life insurance. This type also offers flexibility, but the cash value component is invested in sub-accounts similar to mutual funds. This type could be a good fit if you're willing to take on more investment risk for the potential of greater cash value growth. However, it's important to remember that choosing the right insurance type isn't simply about understanding their differences. Your financial situation, risk tolerance, and long-term financial goals are crucial factors that should influence your decision. For example, if you're in the early stages of your career with a growing family and a mortgage, your needs and risk tolerance might be different than someone who's nearing retirement with a paid-off home and a nest egg. Similarly, someone with significant disposable income might be able to comfortably afford higher premiums for whole life insurance, whereas someone on a tighter budget might prefer the lower cost flexibility of universal life. Moreover, your long-term financial goals play a significant role. If you're focused on leaving a legacy or providing for heirs, a policy with a guaranteed death benefit might be paramount. On the other hand, if you're interested in building cash value for potential use during your lifetime, a policy with a strong investment component might be more appealing. In conclusion, the decision of which permanent life insurance to choose is a complex one, influenced not only by the features of each type, but also by your personal financial situation and goals. It's not a one-size-fits-all solution. Remember, the best insurance for you depends on your unique needs and goals. Always consult with a professional before making a decision. Thank you for watching.